Well, let's now turn to the advisory and talk about the importance of reviewing your super fees, well, not just in super, but fees in general in tough economic times. Helen Baker is the founder of On Your 2 Feet and joins us now. Helen, good to see you again.
Hello.
Fees, look, they're inevitable, but you don't necessarily have to pay top dollar for good advice, do you? And particularly if you're managing your super or perhaps an SMSF.
Yeah. So I guess for people to understand, there's several fees in a super fund, whether it's a retail or an industry one, and even within a self-managed super fund. So generally you'll have the admin fees and then you'll have product fees, and the product fees will change and be higher depending on your exposure to growth versus defensive type investments. And then you may also have advisor fees coming out of super for the super portion of the advice, which of course you have to agree to do. But they're the three sort of elements at the basic ground level of what fees sit inside a fund.
If you've opted for a more aggressive growth strategy in your super portfolio, does that inevitably attract a higher fee?
Yes. So growth will always be higher, but then you have to go, okay, well, I'll go, cheaper fees and change my investment. But obviously risk and return are related. So having more growth investments inside your portfolio over the long term will produce a better return.
How do they actually come up with these fees then? What's the method? What's the methodology?
No, it's not quite like that. So obviously it's a competitive industry,
Yeah.
and sometimes there's a bit of a race to the bottom for certain funds, but it's about being able to justify what are the returns on those investments less those fees, and does it make sense? And so that's sometimes where you see a difference in active versus passive funds. So passive funds will have, like indexes, will be low turnover, lower capital gains, tax costs or losses if it's wrong. And whereas in a growth, in an active fund, you'll pay higher fees because they are active and there's higher turnover. So that's all fine as long as the returns are there on a consistent basis to warrant that.
Can you actually negotiate with your super fund and say, listen, you grossly underperformed? I mean, I guess the easiest way to do that is just to walk and take your money elsewhere. But
Right.
you say, look, you've underperformed. I shouldn't be paying as much as I am for your service.
Yeah, so they're kind of big funds, so
Yes,
generally
yeah.
no. But the voting with your feet, sure. But, I've done some analysis on that as well. And sometimes when you move from the highest performer to somewhere else, the next year they can be, if not the worst, but certainly down that track. So being out of the market is also another risk that you take and a cost that you could bear if markets move substantially through that period of time and you're in a rollover position, which you'd like to think today it just goes from there to there, but it doesn't. It takes some time. Sits in the ether for a little bit.
Now, of course, when it comes to managing money, nothing is for free, is it? So what about the advisor themselves, particularly in terms of recommending super funds and will they take a clip along the way?
So advisors generally will have flat fees in the new world, post the Royal Commission. But what you're looking for there is what strategy and what investment advice are they providing for you? Because a lot of the times we focus on narrowing down those fees and those costs, but actually you're missing out on all these opportunities from a strategic perspective that you weren't aware of, these things that you could or couldn't do. And so it's making sure that, the advisor's helping you through the good and bad times as well. We have a lot of emotional behaviour when markets become volatile, and that can crush your portfolio significantly as well.
All right, let's turn to an SMSF. What are the fees that are associated with that we need to be mindful of?
Yeah, so there's the cost of setting up, which is different to just going straight into a normal retail or industry fund. So there's, the involvement of the accountant or whoever's setting up the self-managed super fund, whether it's the advisor or the accountant, may also involve the legal elm in terms of doing the trust deed and so on. So there's some upfront costs, and then ongoing, it's basically the same. There's the admin costs, there's the investment costs, and then the auditing fees as well. So it's not necessarily cheaper to have a self-managed super fund. In some cases it can be more expensive, but it's about what are you trying to invest in? Can you invest in what you're trying to invest in inside one of these industry or retail funds, or that's what's driving you for example, like commercial property for a self-managed super fund.
Yeah, I mean, clearly, it's going to cost you more, isn't it? Because it's more onerous, because you're in control, but you still need that external advice, don't you? Be it for auditing, just advising over individual investments, for instance, accounting.
Yes. And one of the big issues is when we do self-managed super funds is sometimes people do nothing. And so they could be sitting with their money in cash, which they wouldn't do generally if they're already in an industry or a retail fund. So again, if we're going to do self-managed super funds, there needs to be a strategic reason we're doing it, and then make those actions, because you're still under the same superannuation regulation, whether it's self-managed super fund or an alternative to that. It's not like, oh, it's self-managed so I can just do what I want.
Yep.
You still have to stay within those legislative parameters.
So are there benchmarks for fees that you could perhaps refer to?
I think there is. Like, there's an expectation that for us, like, we like to have our clients' investments under 1% so that there's some good return on that. If there's a lot of active funds, that can be much higher than the 1% for the way that some people invest. So again, it comes back to investment philosophy, and look, every financial advisor will have their own ethos and their own ideas about how you should invest money. So it's about that correlation between the client and the advisor.